fixed income markets have been in focus in 2023, and we're really seeing a pickup in inquiries from clients this year. So it's fair to say it's a very interesting time for the asset class. Now, today I'll be posing some of those questions, some of those sort of topical themes and questions to our resident fixed income investment experts that are here today. And, these are all the sort of topics and themes that we're talking about, that we're writing about. So, hopefully this can provide you with some great insights today. Now, if you do have any questions that you would like to ask, please do submit those. I will definitely leave some time at the end to address those. So without further ado, we can't have a fixed income panel without addressing inflation. So I'm going to kick off there. Greg, let me come to you first. Inflation has come off the peaks in the US and Europe. But is there a risk that it remains sticky and well above central bank targets? Could the market be pricing in cuts too early?
Thanks, Kareena, and good morning, good afternoon, everyone. Thanks for that question. First, to answer your two questions directly, yes, I think there is absolutely a risk that inflation remains sticky to the extent that it's above central bank targets. That doesn't mean it won't fall, but we have a long way to go. And to some extent, I'm going to say yes. There is the risk that the market may be pricing in cuts too early, but I'm feeling a lot better on that front over the last month. You've seen at least one cut priced out of the market just since the end of April. So I think the market pricing there is now much more reasonable. If I step back, though, and I think what is the important question here, it goes, there is a chance that inflation does fall more quickly towards the central bank targets. But I think it's important to note this is likely, in my opinion, only to occur with a reasonable amount of economic pain. So I think we need to be careful what we wish for. I think the most likely scenario is inflation will moderate, but it will remain sticky and only move down over time, and will create some problems for central banks. But if inflation were to fall rapidly towards targets, that's only going to occur with economic pain and labor market pain, and those cuts will come at that point. But I'm not sure we should be hoping for that in the short run, because it'll be a tough path to get there. And then finally, I would just note, while I think we should all take the Fed's forecasts for what they're planning to do with some skepticism, because that's based on their forecasts for how the economy will evolve. What I don't think we should do is doubt the Fed's reaction function. Unless they see inflation moderate towards their target, or they see a lot of economic pain, I believe we should take them at their word that they will tend to keep rates higher for longer.
Thanks, Greg. And I guess in terms of sort of the recent volatility that we've had in the banking sector and the failures that's happened, has that impacted your view in any way when it comes to sort of the tightening path for central banks?
Yes, absolutely. It's impacted my view. It's impacted the market's view. If we look at where the market was pricing the path of central bank policy, whether that's in the U.S. or elsewhere, prior to the banking crisis in March, we were expecting a lot more rate increases. So the fact that the banking crisis that we've experienced and what this is going to mean for the cost of borrowing and the amount of credit creation going forward, this is going to be absolutely going to be a headwind to economic growth. The extent of which is, and the speed at which this headwind will hit, is difficult to measure or estimate. But this is one of the reasons why we're talking about the Fed pausing now, or maybe there's going to be one more hike, where without the banking crisis, I think we would have been looking at 2 or 3 more hikes up to now. So it's absolutely having an impact, but it's going to this is just going to be kind of another brick in the wall, or another factor that's going to make managing the future path of economic growth and the future path of monetary policy much more difficult.
Thanks, Greg. I guess if we turn to the corporate side and staying with the banking sector volatility, John, if I may come to you at this point, do you feel like the recent banking sector weakness has caused you to reassess your view on financial issuers?
Yes, I think we've become a little more conservative on financials overall, but our view is, the banking crisis that was led by SIVB and CS is not systemic, and it's more concentrated in a few select regional banks. And I would say where we're more cautious is on kind of looking at four things within the regional banking sector. One is looking at banks that have a high percentage of uninsured deposits. Also looking at banks that have large unrealized losses in their held to maturity books. And then, there was a lot of balance sheet growth in some of the regional banks over the last several years leading up to, the interest rates rising. So that I think that's another thing that we're assessing. And then the last one, which has been in the press a lot, is just the CRE exposure, specifically in office and in retail. But when you look at the banking sector as a whole, and kind of say, what are the potential losses there from those four categories? There's only a few select banks that meet those criteria that we're worried about. And then if you look at the GSIBs and large banks, they actually benefited disproportionately in deposits from the crisis, as you've seen people move money over to them. So we're watching the sector closely, but that's kind of how we're evaluating and thinking about it right now.
And I guess how quickly might these sort of tighter credit conditions be felt in the rest of the economy? John, I'll stick with you on that as well.
The tighter credit conditions, yeah, we're already seeing that. I think the best indicators, if you look at the senior loan officer survey, which has showed a pretty significant tightening of credit across the banking sector. We're getting up to kind of, recessionary levels if you look at past levels, and it's a good indicator of kind of forward defaults as well. I think our expectation is, with the regional banking pressure, that we'll continue to see tighter credit conditions going forward.
Thanks, John. I mean, I guess one thing about sort of the banking sector, if we think about that, it wasn't just about banks, it was about real estate as well. So the banking sector turmoil did shine a bit of a light on real estate and concerns around that sector. I mean, Seth, do you think that's valid?
Yeah, I mean, I think that the idea of sort of where the next issue could potentially be, whether it be regional banking or large banking system in the United States, is clearly one of the places that at least most are thinking that could come from is commercial real estate, given the run up that we've had in that asset class. I think that's completely valid from the perspective of these are leveraged purchases, right? No one buys a building or a home or whatever real estate without using leverage. So that's number one. And then number two, from the perspective of valuations, we've had a pretty significant repricing of these assets over the past, call it 5 years. A lot of that acceleration as well in the past 2 years or 3 years post-COVID. So I think it's absolutely valid as you start thinking about the next issue that could be percolating would be in CRE. The biggest difference between what we would expect from the commercial real estate market and what we saw as an example in the single family home industry in 2008, 2009, a commercial building is largely done with significantly more equity than what we see in the residential mortgage market. The other issue is when you think about sort of what you're underwriting when you're buying a commercial building, it's cash flow. The more challenging aspect of this is cash flows are obviously being very, very squeezed in certain markets, whether it be retail malls or office space in a downtown central business district. It's hard to underwrite a case that you see an acceleration of rental growth from here. That will make it more challenging to underwrite these assets as they come due over the next few years. And when you think about sort of issuance, more than like, and the other biggest difference, should have mentioned this up front, is the tenor of the bonds themselves, right? In the U.S., you can get a 30-year mortgage on your home. You're not getting a 30-year mortgage on a commercial property. So there will be a rolling maturity as these assets come due. There will be a situation where distressed exchanges, distressed sales, keys being handed back to lenders absolutely happen. Some of this is healthy, some of this is what happens in frothy markets, and some of this will be distressed exchanges that will cause some pain in the financial market. So it is something we are focusing on. It's something we're watching. It is creating opportunities because there are still areas of the world or commercial real estate markets where rental growth is still happening. The industrial space. I jumped in late to the to actually the last panel and was listening to some of the discussion that was happening there, and the rental growth that we're seeing in the industrial and commercial space outside of sort of the traditional areas that are challenged is really creating what we believe to be sort of an opportunity, because most investors kind of, just avoiding the sector as a whole is creating some dislocations in value. So it's going to be a bond picker's market. This is where, active really matters, and digging in and understanding individual assets is going to be key to underwriting whether or not you have a situation that makes sense over the next 3 to 5 years, or a situation where it's going to falter. So this is where I think active matters.
Thanks, Seth. While I've got you on the mic, a common thing that we get questions on is just around sort of corporate fundamentals. We've had a pretty robust earnings season in Q1 2023, so probably a lot stronger than people would have anticipated following the weakness that we started to see kick off in March. I mean, focusing, I guess, on high yield and just valuations in general, I mean, are economic risks being sort of correctly priced into the high yield market, or are they sort of being skewed by, I would say, a deceptively strong set of earnings for kind of consumer firms?
Yeah, I mean, that's one of the more challenging and perplexing things that's happened over the past 18 months has really been the resiliency of corporate credit markets, whether it be high yield or investment grade. I think most of us, if we were asked January of 2022, here's your outlook, declining economic outlook as far as growth is concerned, an overly aggressive Fed raising rates up to 5%, defaults probably starting to pick up, fundamentals that are weakening on the margin. I'm not sure we would have pegged, mid 400s as a good example in the US high yield market as sort of the appropriate level of spread. The resiliency of the corporate credit markets, I think, have more to do with what these companies were doing in 2020 and 2021, which was building massive cash stockpiles by raising debt and then effectively paying down that debt over the next 2 or 3 years, where fundamentals, yes, they're weakening, leverage metrics are getting worse, coverage metrics are getting worse, but for the most part, most companies don't even need to come to market. When you refinance the vast majority amount of debt that we did in 2020 and 2021, particularly in the high yield market, your need for capital over the next 12, 18, 24 months is just lower. So that technical is causing a situation where there's just not a lot of paper coming to market. So that's the technical side of it. When you look at the fundamental side of it, it's difficult to paint a picture that things are going to improve from this point forward without seeing some sort of, reacceleration of economic growth, whether that comes from China or maybe the US at some point as we look into 2024, it's difficult to assume that these metrics are going to be getting better. So back to sort of fair value versus not, the high yield market and corporate markets seem to be pricing in what looks to be a lower probability of a recession. But you can connect that to the equity markets as well. There are markets in the fixed income landscape right now that are significantly more pessimistic in their outlook. And that's where we're really choosing to exploit. The way we're deploying capital today is really more in those areas and away from necessarily the corporate credit markets, where we can allocate capital away in our multi-asset portfolios.
And I guess, John, I mean, coming to you with a similar question, if we think about valuation spreads, what's your view? Are they offering sufficient compensation? I know you cover sort of the multi-sector credit universe, so keen to get your views there. I mean, could we see a pickup in fallen angels, for example?
Yeah, it's there's, I think, several issues you can look at. We're right about median long-term valuations in corporate credit across the regions right now, with Europe being a little bit cheaper than the US. The fallen angels, actually, we expect there's been about 55 billion of rising stars this year, and Seth talked about the technical and high yield. That's also causing the high yield market to contract, and so the high yield market will likely contract again this year. And we our expectations is there could be up to $80 billion total for this year of rising stars. And there's de minimis amount of debt that's been downgraded as fallen angels this year. And a lot of the companies have had a couple of years to prepare for this and have their balance sheets in pretty good order on the investment grade side. So we don't expect a big technical of fallen angels unless it's a pretty deep recession. The second point I'll highlight is on the default rate has been very low. We're hovering sub 2% right now. Another indicator we look at is the kind of distressed or stressed ratios in high yield and loan land. And if you look at high yield, 7% of the index is below $70 price, 3% is below 50, and in loans, 8% is below $80 price, and only 2% is below $60 price. That's a pretty good leading indicator of defaults as well for the next, call it 12 months forward. So, high yield at median levels with a pretty benign default rate and a good technical, I think is a decent setup. Now, the alternative to that is what Seth talked about is if you go over to securitized credit, the ABS, CMBS markets, there's a lot more opportunity over there where those spreads are already near kind of recessionary levels, if you look at that. So, corporate credit, I think, offers some value here, but I do think there's better value in other credit markets. And CMBS would be one of our favorite ones where, we talked about this earlier, the baby's been thrown out with the bathwater, where because of office and retail, and that's a large portion of that sector as well. You have industrial and multifamily trading pretty cheap in those sectors. We like some of the legacy CRT, credit risk transfer securities as well. So those are areas I think where you have even more value in fixed income right now.
Thanks, John. I'm getting lots of questions come through, which is exciting. So I'll try and cut some of my questions short so we can get to some of these. But we started with inflation. It wouldn't be a fixing panel if we weren't talking about recession, which I'm sure everyone else has been talking about as well. If we think about sort of recession, I mean, there's been a lot of debate as to whether it's a mild recession, a meaningful recession, etc. But I think the key thing is that signals from sort of inverted yield curves, some of your sort of leading indicators, they've been signaling a recession for some time, I think, from sort of about April last year, right? Do you, and I'll come to you, Greg, on this. I mean, do you anticipate a global recession, or could central banks actually achieve a soft landing? And if you think about economists, I mean, they're sort of, this is the most documented, the most sort of anticipated recession from an economist point of view. I mean, are they being too dismal? Keen to get your views there.
Well, I don't necessarily know that they're being too dismal. There is absolutely a chance or a hope that we will avoid a recession and the global recession or a rolling recession. There's lots of ways to frame this. There's absolutely a chance that will happen. That probably, at least when I think about the U.S., that's probably not our base case. I think the base case of a mild recession where you have some meaningful weakening in labor markets, some negative real growth is probably the most likely situation that will occur. But we certainly, there's a possibility of a soft landing or something that causes us not to experience that. But I think it's kind of not our base case view that will happen, although we're certainly pulling for it. Just the chances that given how much inflation pressures are in the system, the chances that the Federal Reserve or central banks in general can kind of slay the inflation beast without causing some pain in the labor markets or more broadly seems a little bit unlikely to us. It generally, the idea that it often goes until something breaks. Well, to one extent, we've had one thing break already. We've had a crisis in the banking system, but just like the human body's got a lot of bones in it, when you have an accident, that doesn't mean you're limited to just one thing breaking. So we're pulling for a soft landing, but I wouldn't hoping there will be a soft landing, but hope's not a strategy. And as we're managing our clients' investments, we are trying to be nimble and be prepared for a range of economic outcomes.
And Greg, talking of things breaking and fragility, I mean, how worried should investors be about the US sort of debt ceiling discussions? I mean, is this just a storm in a teacup?
Yeah, I would say, I think I used it before, another brick in the wall or another thing in that wall of worry to consider. I still believe the most likely outcome, and feeling a little better with the recent rhetoric coming out of Washington, that they'll do what we were all saying for the last few months, is they're going to push it up until pretty close to the deadline, but they're going to get, it resolved, because it would be a bad thing not to have it resolved. I think you should be looking at your liquidity, making sure you're positioned appropriately. But I think it's more something that would create short-term volatility over the next few weeks, but probably won't have significant impact going forward, because I do believe we will get past this and move on to the next issue that we have to deal with.
Thanks, Greg. For our audience, I'm coming to your questions now, so let's kick off with those. So firstly, Seth, I'll come to you on this one. The question that we had come through is, given higher underlying yields and wider credit spreads on offer today in government and investment grade corporate bond markets, has that put an end to yield tourism and squeezed access to capital for high yield borrowers at economic costs?
Yeah, I mean, obviously, yeah. I think that the idea to think about, though, is historically the way anybody's capital structure works, right, is a rolling level of maturities. So you only absorb today's rates on what's coming due today. So when you think about sort of my need for capital, if I've pushed out, 90% of my capital stack 5 or 7 years out, and I have 10% of it coming due over the next 1 to 2 years, only 10% of my capital stack is going to be subjected to these higher rates. Now we're seeing, right, you're seeing high yield companies come to markets with 8s and 9s and 10s, and these are yields we haven't seen in a very, very long time, unless we've been in recessions. So yes, this is going to be a pain point for some high yield companies with their ability to finance. I think what needs to be kind of the level setting needs to be put on as to how much capital needs to be actually refinanced between now and the end of 2025. Depending on what market you're looking at it, but if you just kind of look at the US market as a whole as sort of the proxy for what most companies have done worldwide, there's about $250 billion coming due between now and the end of 2025. $250 billion. That was only 6 months of issuance in 2020. So putting it in perspective, when you think about sort of the need for capital versus what the high yield companies need to do as far as refinancing, it's just not there because they were prudent in 2020 and 2021. Same as consumers were. Is everyone refinancing their mortgages, or corporations doing the same? So the cleaning up the balance sheets that happened because we allowed, the Great American Refi, or whatever you want to describe 2020, 2021 as, now we're in a situation where spreads aren't wider because there's just no need for capital. So yes, it's going to put stress on balance sheets. Yes, it's going to put stress on free cash flow profiles of some of these businesses, but very rarely does your entire capital stack come due in a 6-month period. So most prudent CFOs have already done a good job of pushing these things out. So yeah, there'll be some pain, but that probably isn't going to be the situation of what we're going to have a significant issue happening in the high yield market because of that.
Thanks, Seth. One question we've had is that there's been a lot of debate about the relative strength of the market so far this year, and the notion that liquidity from China and the recent emerging lending by Fed has boosted liquidity. With regards to the reversal of QE, could we be in for a tougher period? John, Greg, do one of you want to take that one?
Okay, I can jump in. I think we've had a QE or QT has been occurring for a while, but that's actually, there's been a couple of things that have been offsetting that recently. We can look at two things. One, there's been some incremental liquidity put into the system by the FDIC, by the Federal Reserve, as a result of trying to stem the banking crisis. Another thing that we should keep our eye on, and tie into your last question, Kareena, around the debt ceiling. The fact that as these extraordinary measures have been going on recently, that Janet Yellen and the Treasury Department have been using to avoid a debt default up until now, that's been reducing the amount of the size of the Treasury's cash holdings and that has actually been adding some liquidity back into the system. So as we move forward, and if QT continues and we get past the debt ceiling, this will result in a draining of liquidity And this will be, in my opinion, another pressure point on the economy and potentially on corporations and on spreads as there's less liquidity moving around the system. So this is absolutely something that we are keeping a close eye on.
Thanks, Greg. This is going to have to be our final question, and it's one that you've sort of already answered halfway, John, so I'll pass it back to you for a little bit more. So different asset classes within fixed income are pricing in different scenarios. What areas of fixed income are looking attractive here from an asset allocation perspective? That's the question.
Yeah, thanks. I'll reiterate what I said earlier. It's on the securitized credit side, and I'll start with the agency mortgage market. If you look at agency mortgages versus IG corporate credits, they're at very wide levels now, and I think there's reasons for that. One of the major reasons is you have the disposition of the portfolios that were taken from the regional banks that failed, and they're being sold in the market today, and that along with QT as well has kind of blown out spreads in the agency market. You look at CMBS, you look at even CLO liability spreads. CLO liability spreads are trading wide to corporate credit for higher ratings. So that's another area of the market we like. We like residential credit with credit risk transfer, especially kind of what we call the legacy portion of that market, which predates the run-up in house price appreciation pre-COVID. So we think there's a lot of cushion in there, and you've seen the agencies actually tender for those bonds. So those are really the areas that we like. One more I might add in there is the ABS market is trading extremely cheap, especially in auto. You can pick up high quality bonds where you can run through kind of a GFC type recession scenario, and there's really de minimis credit risk there, and you're receiving almost GFC type spreads on some of that stuff as you go down in credit quality. And then maybe one we're a little bit more cautious on is the loan market. If you look at the loan market, you have a pretty big weight of the loans from S&P that are rated B3. And that's an area where we could see some downgrades into CCC, and I think that would be a pretty bad technical, given the CLO market is around 65% of the demand for the loan market. And that's coupled with a lot of the, unlike what Seth talked about in high yield, a lot of loan issuers didn't hedge their interest rate expense, and they're either tied to legacy LIBOR or SOFR. And as SOFR has increased, their interest coverage ratios are deteriorating much more quickly than in the high yield market, where they have a lot more fixed rate debt. So that's probably one of the areas of the market we're a little bit more cautious on from a technical and a fundamental perspective.
Thanks, John. Well, we could talk fixed income all day, but I'm being told that our time's up. So thank you, Greg, Seth, John, for all your time today and for your discussion. Thank you to everyone that's listened in, and I'll hand over back to Sarah.